What a crazy week that was on the European energy markets. But my promise to you today is to not start speculating about developing news because there is way too many moving parts right now. So we cannot have a correct assessment of the supply and demand balance right now and what it all means in the short, medium, and long term with the war between Iran and the US. So that's why it's really important to focus on the price action because we don't need to understand why the market is moving. We can still profit from it, or let's be real, lose quite a bit of money here. So, more important than speculation on the next fundamental development is actually acting in accordance with what the price is actually doing. And the best way to actually get started is by building a system around combining your existing fundamentals with technical analysis. So if you scan the QR code, you can sign up to the free masterclass where I show you the workflow that I'm going through on a daily basis here at Clever Markets to get a better grasp of the next market move. Most of the time, even during normal markets, it's more about what the market thinks the supply and demand balance is doing, not what it's actually doing. All right, let's get started. Of course, everything you see here is just my personal opinion and does not constitute trading advice. And also, it is not an invitation to trading. So, this is the TTF sentiment benchmark that we have for this Monday, the 9th of March, 2026. So, every week we are asking our LinkedIn network where they think the TTF is going to go next week. And you can see nearly 60% of you say that the market is more likely to continue higher. Only a quarter believes that the market will decline, and we have around 14% of you who think that the market is more likely to go sideways. So the sentiment is super bullish, and what we do with that is we take that information and we go with that onto the daily chart to see where that sentiment fits in with the actual price narrative. All right, let's have a look. So we did see, of course, we had 2 days of strong gains. Then we came off a little bit. And for the past 3 sessions, for the second half of last week, we did see that the market has been moving into this increasingly tighter range. So right now we are in a congestion area. So what we did is we put on Fibonacci retracement levels. So the 0 is up here and the 100 is down there. And you can see we are near the 61.8% Fib retracement at 43.73. So here's the thing. If the price manages to move below that level, then we will be seeing a more pronounced move lower, potentially towards the 38 area where the gap border is from the 2nd of March. If we push below that, not saying it will, but if, then very easily could we make it towards the 33 to fill the gap because there's nothing else in the way. However, this is only the alternative scenario. The preference overall is still bullish continuation. And that is simply because the momentum tools are strongly bullish. Our proprietary indicators are also signaling bullishness. We are seeing that the stochastic currently is a little bit flatlining, but that is because of the past 3 sessions of hesitation. But overall, we are still making higher highs and higher lows. And we are also seeing that, of course, after this enormous spike, we did get a golden cross. And the golden cross is where the shorter term exponential moving average, so in our case, the 8, the white line, moves above the longer line, 12 in our case, orange, and both are already pushing higher. So this means that we are bullish, but right now we are even more bullish. So the uptrend is accelerating. So, but what do we do with that range, right? So if the bears are confirmed below 43.73 and the bulls are confirmed above 65.79, this is a ginormous range. So how do we actually trade this? Well, ideally not on the daily chart. For that, we want to go onto the hourly chart to make use of the smaller swings. And here you can see, right? So this was the big gap. We pushed higher, we came off a little bit, and right now we have this here. So this is an ascending triangle. We are not 100% happy with this. So you could also, if you wanted to turn this into a symmetrical triangle, works just the same. So what is the difference though? So ascending triangles tend to be resolved higher because it shows us that the market is willing to buy at higher and higher prices, whereas the resistance remains the same. And we put it because we've got this level here, kind of coincides with that. And here, of course, it doesn't align anymore. So the bullish trigger essentially is a move above the 55.67, which is when the ascending triangle would be resolved higher. Then we could make it towards these two intermittent peaks, 61.41. We could reapproach 65.79. So this would be the preferred ascending triangle breakout direction right now. But here's the thing. Let's have a look at the momentum. So on the hourly chart, it does look a little bit more dramatic. We have come off significantly, but right now we are pushing a little bit higher. But within the triangle, do not use trend and momentum tools. So that means the MACD I just showed you, also the moving averages 8 and 12, because they do flatline, they do give us wrong signals, and especially in such highly volatile markets, they're a little bit of less use. So what I want you to do instead is to look at the actual price level breaks. So here's the thing, a move below 51.51, like in that area. So wherever we hit the ascending triangle support, if we break below that, then the alternative case will play out, the bearish case. And the move above 55.67 would mean that the bulls are continuing. So if you're working with a symmetrical triangle, on the other hand, where we are trying to combine I don't know, maybe something like this. And yeah, I think this here doesn't look too shabby. Then, of course, you would generate an earlier signal. Probably we would then push it towards here at the 53.84, which would mean a move above the most recent peak and also a move above the symmetrical triangle resistance. So you can see this signal would be much, much earlier than this one here at 55.1, which is the most recent peak, or this resistance confluence area in the 57 region, right? So we would get an earlier signal, but then there would still be a danger of the market turning sideways if we are not waiting for a move at least past this resistance area up here at 55.1. So we could still then break a little bit higher, or maybe even here, right? So we might break a little bit higher, and then we would still be stuck in a range because we haven't really made it past an important resistance level. So that is the danger. If you see it as a symmetrical triangle, you would get in a bullish trade earlier, but there would be a greater risk of the market simply pushing sideways. And then you would have a long position caught up in a market that's going nowhere. Overall, we still believe that the market can continue higher. So if you are okay with having resources tied up in a market that isn't going anywhere, in the hopes of it eventually resolving higher, then you're okay to go, I guess. But everyone who wants to wait for a little bit more of confirmation and is willing to not get in at the very bottom, so at this breakout exactly, then maybe consider this or this level, the 57, or what was this here? The 55.1. Now let's have a look at the German power markets. They also seem to be ready to move a little bit higher. So here on the daily chart, we are working with this giant ascending channel that's been in place since early 2024. So this is best observed on the weekly chart as well, by the way. So let's zoom in. We are now approaching the upper end of this channel, around about the 95 area. So the market could easily push towards it and test the 95 area. It's a psychologically important level. It is the channel resistance. At this point, the market will have to make an important decision to push onwards or to correct lower. With the tools available to us right now, this includes our proprietary in-house algorithms and also the classic trend and momentum tools, it still looks like a move higher overall seems more likely. So let's have a look at the hourly chart here on the German power markets. You can see we put on some fib extensions just to generate a target. So you can see we have this distance measured here from the most recent up leg. We then waited for the correction to play out, and then we put on the fib extension. And you can see just by chance, the 61.8% fib extension somewhat coincides with this peak here from the 3rd of March. And the 100% extension is all the way up here at 96.51. So this is higher than the daily chart's 95 channel resistance or the psychological level. So that's why we think a push above the channel to accelerate the uptrend is possible, at least for now. So also here we see on the hourly chart that the momentum is up, the trend tools are up. Also, no bearish indication at all on the stochastic, so the market still seems healthy and bullish. Now, how do we know that the uptrend is coming to an end? Well, if here on a Monday morning we start seeing an extended sideways period, we don't push above the 92.21, maybe even a move below the 86.8, this would then slowly, gradually put the bears in charge. But be cautious. There's always a risk, especially at such important times, of a sideways range forming within 85.15 and 92.21. So be careful that not something like this here happens, okay? The sideways range would not immediately undo the bullishness on the daily chart, but it would definitely slow it down for a little bit. And the last market for today, let's have a look at the EUAs. So on the daily chart, we are within the sideways range of 68.11 and 74.5. And within that range, on the daily chart, there is no real good trading opportunities at all because the range is way too small and we are just dealing with like one or two or three candles into one direction before we revert. So in order to make sense of that, we go into the hourly chart. And you can see here we have marked out the 69.59 and the 71.73. If we remain within this range, there is no trading opportunities. If, however, we push marginally above the 71.73, we could make it to the rectangle upper range at 74.37, or we could push below the 69.59, which could then lead the price towards the 68.18 or below. So right now, as you see, we are only firm on the sideways, but we are not firm yet on the subsequent direction. Now, here's the thing. If we push above 71.73, doesn't mean we are bullish. It simply means that the range is more likely to continue. However, if we push below the 69.59, the bearish confidence would slowly grow. And if we make it below 68.18, then the range would be resolved. And on the daily chart, the bear trend would continue. So you can see here, eventual bearish continuation on the daily chart is still our preference, which also means that the bearish case here, so they're both two, which means there's no preference right now, either delay of the downside with a continuation of the range or immediately downside resolution. But overall, the immediate bearish case looks a little bit more bearish, right? If that makes sense. So overall, try to avoid trend and momentum tools on the daily chart. If you want, you can work with oscillators on the hourly chart, but even in this tight range here, be careful. Also, don't make use of the trend and momentum tools on the hourly chart. And that was all for today. I hope you found this insightful. The markets are tricky right now, so make sure you do sign up to the Clever Markets Masterclass on combining technical with fundamental analytics. Everyone, stay safe out there. Have a good start into the week, and bye bye.